Hi, this is Mani from bsc2nse.com. In this video, I'm going to talk and give a basic introduction on Heikin Ashi candlesticks, which is just a slight variation from the normal candlestick patterns or charts. So this is for people who already know a bit about the basics of candlesticks. So this is a 5-minute chart. It's the same chart. It's the Nifty daily chart in terms of futures, Nifty futures daily chart, and each candle represents one day. So the opening price in the normal candlestick is taken as the first trade that happens in the morning at 9:15 in the normal candlesticks. But in the Heikin Ashi, what they actually do is the opening price is considered as the average of or the mean value between the open and close of the previous candlestick. So in other words, they take the open price as the average price or the middle of the candlestick, middle point of the candlestick, or the average traded price, something like that. So basically what they do is they make use of the previous day's candlestick value to decide what should be the opening price of the next candle that gets formed. So in a sense, if the previous candle was a negative candle, the opening price will be taken a little higher than the actual opening price. So that way, if the previous candle is negative, the following candles in Heikin Ashi will also look to form as a negative candle unless the price really comes above the previous day's candle value. So it avoids a bit of false positives in a negative trend and false negatives in a positive trend. You can see that here in a positive trend here where Nifty is actually moving up, but there's one particular day when Nifty closes below the opening price or the 9:15 price. But in a Heikin Ashi, even this candle is taken as a positive candle because the closing price is still above the previous day's candle average traded price or the mean price. So here there's no false negatives on a positive trend, and similarly when it is going down on a negative trend, any false positives that can occur, it does not show up. Again, at the fag end of the chart here, you can see that there's a negative candle here, a big candle, and then some recovery and a small negative body candle. But in a Heikin Ashi, you will see that this still draws it as a positive candle because it takes the opening price lower, which is actually the mean price of the yesterday's positive candle. So, and the other things that you can Google and find the exact calculations as how the Heikin Ashi modifies its own opening high and low and close values. And simple logic that you can arrive at is that in a negative trend, once a negative trend starts, or once you see a negative candle with no sticks at the top, meaning you can see in the normal candlestick pattern, you can see the stick here because the high price and the opening price is not the same. But in Heikin Ashi, you will find that because of the logic how Heikin Ashi draws the candle, the open and high become same in a negative trending movement. You can see 4 consecutive negative candles here wherein there is no sticks at the top. So that's a clear indication of a negative trend. Similarly, on a positive trend here where I marked with a white line, you can see that there's no sticks at the bottom. The open and the lowest point is the same, or in other words, the open is equal to the low value for 4 positive candles consecutively, so which indicates a pretty strong positive pattern. And then you can see a stick at the bottom, which indicates that the positive trend has gone into a pause, and then again a bunch of dojis, and then again the negative trend starts. So in a positive trend, as soon as you go long, you should look to book profits as soon as you see some sticks at the bottom. Similarly, once you go short on a negative trend which has no sticks at the top, as soon as you see a stick at the top here, you should look to book profits on the short. And again, you can see here two candles with no sticks at the bottom, and then a doji, and then no stick at the bottom candle here. So this indicates that the trend is going positive here. So whenever you see a candlestick on the daily chart getting formed with no sticks at the bottom, you should look to go long and make money on that. So which you cannot see clearly on a normal candlestick. You can see that for 3 candles there are still sticks at the bottom. So only here it's little different, but otherwise you don't see that normally, but you can see that clearly here. Similarly, you can see that 2 candles where no sticks at the top, and then the third negative candle has a little bit of a stick. So that's early signs that you need to be booking profits, and then the trend again changes. So these are things that you can make out from I would definitely be going forward using Heikin Ashi candlesticks more than a normal candlestick chart, because it is easy to identify a trend, and it's easy to identify when the stock is not trending. For example, you can see that here there is no trend at all because there's sticks on both the sides. These candles, you can see that there's sticks on both the sides, so there's still confusion, or there's no clear indication of a direction here yet. So after a positive trend, it's just a pause or a consolidation phase. And then with a negative candle with no sticks at the top, it's a clear indication that the trend is changing into negative. So just by looking at stick formations in the positive and negative candle in a Heikin Ashi chart, you can very easily follow the trend. It's a very simplified manner and a easy approach to following a candlestick pattern. And let me show you how to get this chart in a Zerodha Pi. At the top you have a drop down here. I have set it to Heikin Ashi, the price style. So let's say Nifty, here you right click and you click on the chart option at the bottom, and then here you get the periodicity as day, hour or minute. You can use the Heikin Ashi chart even for intraday charts to trade and to get in and get out, to get the best entry and exit points. So positional traders can use the daily charts. Intraday traders can use the minute or hourly charts. So click OK to get the daily charts, and this is the daily chart, and by default Pi will give you the candlestick chart here. So after you load the chart, every time you need to come down, and then you can see Heikin Ashi here. So in the Heikin Ashi you can see that there's no sticks at the bottom here on the daily chart, which is an indication of a positive trend, and then a bunch of consolidating candles with sticks at both ends, and then a negative trend getting formed for 4 days with no candles at the top, no sticks at the top, and then minor positive trend wherein some sticks in the middle, and then 2 candles without sticks at the bottom, and then one more candle. So it's easy to look at the trends here. You can see that a bunch of 4 or 5 days of positive candles with no sticks at the bottom, and then a doji bar, 3 days of doji, and then one strong negative candle which indicates that the trend is changing, but then again the next day itself it changes a bit again, and then the subsequent candles again going positive. So similarly on the left here you can see 1, 2, 3 days of consecutive negative candles with no sticks at the top, and then a negative candle or a consolidating candle with both sticks at both the end, and then couple more negative candles, and then you see some amount of consolidation and the trend reversing here. So here you can see no sticks at the bottom and the trend reverses. So it's pretty easy to follow it like this, and you can try it and include this into your trading logics. Let me know how it goes, and as usual, any questions or queries, post on this video. Subscribe to our YouTube channel to stay in touch, and join our trading group to get a free training from my side. That's it for now. Thank you. Bye bye.